And this is despite the valuations that look pretty elevated right now.
Yeah, they do. Certainly, that's probably the biggest concern. So the theme we have for 2021 is vaccinating against those valuations. And if you look at valuations across the board, whether you're looking at bond markets or equity markets, obviously we see relatively high valuations, but we don't really see that changing too much. And we see fundamentals actually catching up in 2021. So obviously the second half of this year has been very much focused on looking through the pandemic. Vaccines should help us to continue to do that, especially if we see some fiscal stimulus. So yeah, it's going to be, we believe it's going to be another good year for investors. Bond yields likely capped, and as you mentioned, multi-asset income strategies still very, very favorable for investors as well.
Is this the right time to jump in, though? Because we have already seen a huge rally, right? Especially in the value sector. Cyclicals have also been bid up.
Yeah, I think if we were having this conversation 3 months ago, we'd probably be having the same conversation, right? We've seen a very strong rally and the market has continued to go higher. I think it is difficult to know exactly when to jump in. Markets do look a little bit stretched. We do have some short-term uncertainty. So, if you're looking at the actual vaccine developments itself, yes, it's good news, but it's going to take a long time, probably until the second half of the year, next year, before we start seeing huge amounts of people being vaccinated against the virus, and that's assuming things go pretty well. So, so we may see some short-term volatility, of course, at points along the road, and I think the U.S. fiscal development is going to be key in the short term. But ultimately, we don't think any pullbacks are going to be that significant. So I think investors shouldn't be too patient if we do see that short-term weakness coming through.
Steve, with the reset that a new year brings, are there any contrarian plays left? Because we haven't really spoken to anyone who isn't bullish equities, bearish the dollar, bearish US Treasuries.
Yeah, and that's probably the risk in terms of the short-term outlook. You could see some pullback. I think the real contrarian play, there's two areas to look at. So one is gold. For us, we have been bullish gold over the past 12 months, and that's worked pretty well for us. But we've taken that view now and said, actually, we don't want to be overweight gold. We still have a slight upside bias towards gold price, but we don't think it's going to outperform other asset classes. And that's partially on the fact that we saw gold actually weaken as the dollar was weakening. So that was a major driver for us. And so that breakdown in correlation is a little bit concerning. So that's probably our biggest non-consensus view out there. The other one to watch out for is obviously the value versus growth debate. Now, we've seen massive underperformance of value over the course of the past 10 years and particularly actually over the past 12 months. And so that, but it seems to be a consensus view that we'll see value outperform in the coming 12 months, which we would agree with. We think it actually might be front loaded as we see a sharp recovery in the economies in the first half of next year. And so we could see a strong outperformance of value in the short term without necessarily changing the long-term trend. For that to happen, we need to see bond yields going materially higher. And at this stage, we're not convinced that's going to happen.
Steve, I want to throw up a chart taking a look at the emerging markets performance with or without China, because I think that's actually quite an interesting question, given that in comparison, you've actually seen Chinese assets underperform the broader EM complex. This is taking a look at the EM equity ETF outperforming in a basket that doesn't have China exposure, the yellow there, ex-China. Does that trend continue, do you think? Because, at the same time, we do have MSCI China, right, at the highest valuation since the inception of the index itself. So where does this go, and does China still remain, I guess, the EM anchor sentiment-wise?
Well, I suppose what happened is, if you were to draw that chart over a longer period of time, then China would stack up a lot better. And, that's because China was the first in, first out from a COVID situation. Obviously cases peaking in the first quarter and then the China recovery coming through. So fundamentals still argue that China's going to do well. Growth is going to accelerate. We're looking for around 8% growth in 2021. I suppose the question is, to what extent is that priced? But we do believe that China is still going to do very well and continue to outperform over the longer term. That growth profile, as I mentioned, there is a slight concern about policy being We're certainly not going to be more stimulus coming through, but we're watching for the MPC in March to see what that delivers. But we continue to be bullish on China equities.
So what about for the bond market going into next year? Are we expecting to see the flood of issuance really take some of the exuberance out of that?
So if we're looking from a global perspective, we see bond yields being capped. If you come to Asia, we still feel that Asian credit is a very good area to be invested. So obviously we've seen some pickup in defaults in China, and obviously we have seen an acceleration of issuance around the region as well. But overall, we believe that spreads now are very wide relative to their US counterparts. And we believe the macroeconomic backdrop in this environment is actually more favorable. So from that perspective, yes, we're seeing a pickup in defaults, and that is something that we need to keep an eye on. But overall, the pricing, it looks pretty attractive. So we are overweight Asian credit in our 2021 outlook.